everyone. I am Radhika Gupta, you know me, and welcome to another edition of Connect with Edelweiss Mutual Fund. I have to say, for those of you who are mutual fund investors and advisors, it's probably rare to see an asset management company do an event on an asset class that historically has competed with us, and that is real estate. But it's also an asset class that in my conversations and the team's conversations with all of you, everybody has some question about or some opinion about. So whether it's a question on home prices in Bombay or Delhi or Pune or wherever you're logging in from, whether it is what will happen to commercial property and how much this work from home will take over our lives, whether it is about REITs or whether it's about real estate trends in the rest of the world, I think this is something that we've all had questions on. So we thought, why not have someone who knows this topic in and out talk to you about an asset class that we can't ignore, even though we're in the business of financial investing. I want to take an opportunity to welcome and introduce our speaker today. Ramesh Nair is the CEO and country head of JLL India. JLL India is a business that doesn't need an introduction. JLL is a Fortune 500 company that focuses on advising and creating value for owners, investors, and users of real estate. They are actually a company and a team of 12,000 people. I think Ramesh told me this in India. And they're a market leader, both in terms of market share and revenues, but also in terms of thinking team size across different segments of real estate. Ramesh has about 22 years of experience in the real estate business. He's worked across asset classes, whether it's office, land, retail, residential, warehousing, advising both domestic and multinationals. I've heard him a couple of times, and every time I listen to him, I feel a little bit smarter about real estate, which is a domain I don't know very much about. So I'm really happy that he spared time out of a very busy calendar to talk to us today. The format of this event is something that you're familiar with, but just to repeat, Ramesh will probably spend about half an hour covering different aspects of real estate, and he's promised to cover the landscape, whether it's residential, commercial, investment, hotels, the whole range. And then I know that this is a topic that everyone has a lot of questions on. So I would encourage you to post your questions on the chat window using Zoom. And after the first 30 minutes, we'll start taking those questions. So with that, thank you again for joining so much. And over to you, Ramesh.
Thanks, Radhika, for that kind introduction. And I will, like you said, I will cover 3-4 asset classes. We'll talk a little bit about residential, then we'll move to office. We'll also look at industrial and retail, and also look at what's happening on the investment front. Let's start with residential. Crisis is unprecedented. One good thing that is happening is home loan rates are at a 15-year low. The developer community was expecting a one-time restructuring plan from the government, like what was done in 2008, but that hasn't happened. Projects are going to get delayed. Residential projects are going to get delayed at least by 6 months, mainly because of two reasons. One is migrant labor. The construction laborers have gone back. Second is the obvious liquidity shortage. Price correction is expected. We'll talk a little more about that slightly later. New launches are going to significantly drop. The main objective of a developer in these times would be to sell whatever is available. He wouldn't focus on new launches. Developers would customize apartment sizes going forward. We believe sizes would change. Previously, you would see developers doing all kinds. So one day he will do office, next day he'll do residential, third day he will do retail, fourth day he will do hotels. But going forward, we believe developers will focus on a single asset class, whatever he is good at. So residential developers will end up focusing on residential. There's massive amount of consolidation that will happen. There was a study which was done a while back. It said that out of 3,500 developers who were active in 2012, 13, only around half of them were active around 2019. We believe that number will again significantly drop, which means more consolidation happening. Buyers will end up delaying their decisions. That's something everybody needs to be ready for. There's going to be a lot more focus on safety, health, and wellness in projects. We believe developers will end up using a lot more tech adoption going forward. There would be a lot more focus. I think residential, there would be a pent up demand going forward. Some of the other things which are very different from the 2008-9 crisis is, if you remember back in 2008-9, most of the buyers were investors and speculators. Today, most of the buyers are end users. Back then, valuations were not very realistic. Today, the valuations are very realistic. The NDA government has done a good job in terms of giving tax breaks, tax benefits, especially for affordable housing. That's again good news. And today, if you look at it, developers are doing a lot better uh, from a sizing point of view than what was there. 2008, you used to see all those big luxury, big size apartments, and today it's very relevant in terms of sizing. Now let's look at it a little more deeper in terms of supply trends. The last 3 months, the launches have been close to zero. Very negligible amount of launches, mainly because of lockdown. And even if the few launches which have happened at good pricing and good sizing, developers going forward will focus on very fast turnaround time, which is again good for the buyer, which is turnaround from a design build and sell. So developers will keep doing more of that. We believe buying behavior will change going forward. Like I said, there'll be a lot more focus on hygiene, safety, and wellness. There is from a buying behavior point of view, the last time around, the aging millennials, people who are in their late 30s, this is the second recession they're going to be seeing. So need to wait and watch how they are going to react to this downturn again. There will be a little move from dense areas closer to the CBD towards suburban areas, because people would want more distancing. Housing as a necessity will further gain prominence thanks to COVID-19. We believe people will want to own more homes. From a design point of view, apartments will incorporate features like study areas or study rooms. There would be more open areas which will come up. Telecom, Wi-Fi connectivity, all that becomes important for homes. Demand typically is going to be for projects which are nearing completion and slightly bigger apartments. In spite of year, we all know that the last 4 5 years has not been very good for residential. But if you look at it from a 10-year period, from 2010 to Jan 2010 to Jan 2020, uh, residential pricing has still gone up 41%. Markets like Pune, where it went up 90%, and markets like Chennai, where it did go up very much. So still across the country, we have seen a 41% capital appreciation without inflation adjustment in the last 10 years, which is not bad in spite of the industry going through lots of ups and downs. Good news for a home buyer is the last 4 5 years, prices haven't gone up, which means time value correction has already happened. Real impacting on pricing will be, I think, felt in the next couple of months. Room for price drop is limited, given that developers over the last 4 years have already seen good amount of correction happen. But developers who have the capacity to hold will hold the price. Developers who don't have the capacity won't hold the price. We have seen that in luxury projects, developers have already started offering around 5 to 7%. These are people who don't have the ability to hold too long. In luxury, 10 to 12%, and for mid market, 5 to 7% discounts. But these discounts are not offered as rack rates. These are only offered at the end, if the developer feels the buyer is serious and at a last stage of the home buying process. So this is what is happening on the residential front. Biggest challenge in the residential front today is how many end users will actually want to buy when he's going through uncertainty with regards to both his salary as well as how much is the salary going to be in terms of cash flows, whether there are going to be salary cuts, and also uncertainty to actually retaining his job. These two things will definitely have a impact on the residential buyer. With that, we'll move to the office sector. Office sector, the market fundamentals are still very landlord favorable, but slowly it is moving to become tenant favorable. There is construction delays, like I mentioned in the residential sector, the same construction delays. We expected some amount of force majeure and rent abatement debates back in April. That hasn't happened. Most large developers I've spoken to have confirmed that they're getting anywhere between 94 and 98% of the rental, even during lockdown, which is a very healthy sign. But this is definitely not the case in retail. But going forward during renegotiation, there will be a good amount of renegotiations at the time of renewals, because let's say you're paying ₹100 rental now, and 1 year down the line, lease is coming for renewal. It's going to become 112. The same developers are going to come back. The same occupiers are going to come back and say, when the market is going to maybe drop from 100 to 90, why should I be paying 112 or 115? So there'll be a lot of renegotiations there. We believe the concept of de-densification will happen. De-densification is the opposite of densification. So what's happened in the last 10 years is most projects have densified between 15 to 20%. What I mean by that is if clients were putting up 100 square foot per person, over the last 10 years, that became 85 to 80 square foot per person, which means more number of people being put in the same amount of space. Going forward, I believe the opposite will happen, which is de-densification, which is more from a social distancing point of view. Please remember, if at the current rate, at the current rate of social distancing of 6 feet and 2 meters and all that, companies can only occupy maybe 40 to 50% of the people which they actually were occupying pre-COVID. That also needs to be kept in mind. We believe absorption this year will at least drop by 30%. And demand will also drop anywhere between, supply will also drop between 30 to 50% this year. Vacancy rates are expected to go up. Reduced demand is mainly driven by uncertainty. We also believe many tenants will, while taking new space, will ask the landlords to do the capex. This is again because they do not want the capital expenditure, basically the money spent on interiors, to hit them this year. We believe lease structures will likely change. The tenants will insist on more flexibility in agreements, which means lock-in periods will have to reduce. A lot of tenants are also now asking for more rent-free periods, because it's not easy to get one, labor, and also material because of supply chain disruptions happening across the world. So a lot of interiors you see in your offices comes from Southeast Asia, China, Malaysia, all that. So there is going to be delay in that also. Occupiers will demand better quality assets, which means better quality air conditioning, air filtration, air ventilation systems, better mechanical and engineering systems. I believe the demand for better quality buildings will go up, because occupiers will have to have better quality buildings to attract the best of talent. Occupiers, like I said, would want to. We have one trend we are seeing post COVID is requirement sizes are also reducing. So your 100,000 square feet requirements have suddenly become 80,000 square feet requirements, because occupiers don't want to take such a big risk. Tenants have also, one good news is tenants who had pressed the pause button over the last 3 months have now come back and started pressing the play button again, which means decisions which are on hold are again getting back into action mode. Work from home, so much of debate. We did a survey internally on what will happen to work from home right now. Everybody is working from home. Even in the country today, less than 10% of the offices are occupied, which means 90% of the people plus working from their respective homes. But the question we asked our clients was post things getting back to normal tomorrow, assuming there's a vaccine there and things get back to normal, maybe in the medium term, could be 6 months, 1 year down the line, what percentage of people will permanently work from home? The answers we got was anywhere between 5 to 25%. And even if you have to take an average of that, that's around 15%. That's what I believe, the amount of people who will end up working from home. So even if you look at taking a shift, 1 day out of 4 days. So you work 4 days in an office and 1 day you work from home. That itself is 20%, right? So I think companies will do that, but not too much of space will be lost to work from home. The other reason being you need to have social distancing. The other day I was talking to a large American bank, which has many thousands of people working out of the global in-house center in India. And they were telling me that they used to have 100 square foot per person before, and now they're going to make it 150 square foot per person. So this demand which is being lost because of work from home will get neutralized to some extent because of increased space requirements. Occupiers, like I said, will reduce their demand, giving the economic uncertainty. They will also want to cut costs. In the last 3 months, what we have seen is many occupiers was waiting in the sidelines, given more clarity coming out of the economic fallout of COVID-19. And like I said, you can't have more than 45 to 50% space if you're actually maintaining all the social distancing. So how are landlords behaving? We are beginning to see the a little bit of sublet space come in, which is basically a tenant saying, "See, I have 100,000 square feet now under a contract with the landlord. JLL, can you help us? There's a 10, 15,000 space which I don't have. Can you help us give this to someone else?" That's what we call a sublet or sublease space. New supply will obviously reduce. Increase in rent-free periods, vacancy rates will go up, like I said. Traditional office landlords, we believe, will get into more flexible office spaces. Landlords will have to upgrade older buildings because given all the challenges with regards to air conditioning, air filtration, all that, old buildings need to be upgraded with newer features. Landlords will want to limit rental increase to existing tenants to basically make sure they don't tenants don't leave their buildings. More, I believe, going forward, the buildings would be more smarter, more intelligent, more human buildings will come up, which means more healthier buildings. Landlords who are fast and agile will succeed, and landlords need to support tenants to regain the existing tenant base during these times. And we are seeing some landlords kind of getting onto that also. A thing which will definitely impact is social distancing, and public transportation has a direct impact. When will public transports open up, transportation open up? Because not everybody has their transport, uses their own transport to come. Dependence on public transport in the big cities is still very high, like trains and buses and Uber and all that. So that's going to take some time for it to kind of get fixed. But going forward, one thing is very clear. One size fits all approach will not work in commercial real estate. If you've seen, all buildings used to look the same. So going forward, that's definitely going to kind of going to change going forward. Buildings can't be the same. You will need to have more customized solutions for different types of tenants. With that, let's move to retail. Retail is the sector which has been hardest hit. Sector was caught off guard. Vacancy levels in malls, once it opens up, I think malls will begin to start opening up in most parts of the country, maybe in around August, especially in cities like Mumbai, where there's still a lot of uncertainty. In some cities, it's already opened up, like in Bangalore. Vacancy levels will definitely go up once the malls open up. Some retailers will definitely go bankrupt, given that they operate in very thin margins. I think some government related relief is required for boosting consumption. There are some landlords, mall owners, who actually gave concessions. to their retailers during the lockdown. Many of them still there is a deadlock. So both sides will have to come together and negotiate a reasonable point where it's a win-win and both people are sharing losses. As retailers face competition, e-commerce players are doing quite well. We were hoping that there would be things would revive in the mall sector towards Diwali. But given that there is relapses of newer cases happening all over the country, I believe that would get pushed towards early 2021. On one side, you're seeing e-commerce giving retailers competition. On the other side, you're seeing multiplexes getting huge amount of competition from OTT players. Leasing volumes is definitely going to decrease in terms of newer expansion plans, as expansion is the last thing on retailers' mind right now. We believe the hypermarkets and the supermarkets will end up doing well. A lot of retailers were planning big rollout plans for tier 2 and tier 3 cities. That'll slow down. Retailers will start focusing more on omni channels, which is having your online and offline presence. Number of outlet stores, we believe, will increase. Many retailers, like I said earlier, are renegotiating their deals back to with landlords, especially on aspects like minimum guarantee rentals and base rent and revenue share deals. Both all are there. Are a lot of staff layoffs and salary cuts we have heard in the retail segment. One thing you need to keep in mind is very few retailers actually have deep-pocketed parents to kind of take them through whatever is happening. Because of which I said there would be some retailers who will go bankrupt. We believe this will make a lot of retailers increase their tech adoption going forward. These retailers will end up decentralizing their supply chains. They wouldn't rely on one country or two countries, given whatever has happened. They would want to decentralize their entire supply chain. They would end up creating more robust business continuity plans. There would Many retailers will try and push for pure revenue share deals. We'll have to wait and watch how many landlords accept on that. One trend I saw was, which I heard from retailers, was things started improving in the first week when things opened up, but the second week again the sales fell. So it was basically people who wanted essentials who came to all these stores. I was hearing about how sales for laptops, printers, all that in digital has gone up. Essential sales like undergarments and those kind of things have again kind of gone up, but non-essentials like jewelry and those kind of things, sales have literally come to zero. Nothing happening there. So mall owners will have to be ready for lower footfalls. They will have to compromise with retailers and reach a deal there. Like I said, revenue share dynamics will change. Like in office and residential, construction delays will also have will impact new mall development. Mall developers are all thinking, how do I reduce my fixed overheads? And everyone is trying to busy renegotiate with bankers. Anyway, you have the 6-month moratorium. The government, there's been a big mall owner lobby which is trying to try and convince the government if they could consider GST input tax credit for mall owners. Grade B malls will be a lot more hit than grade A malls. Landlords who are mall owners will have to offer more fit out subsidies if they want to attract, like tenants would come and say, can you do the AC and ducting for me interiors? Why? So these kind of deals will happen going forward. So rental support for retailers is the need of the hour for mall owners, and some of them have, like I said, some mall owners gave 100% deferment during lockdown, while some gave off 50% during lockdown. And some even in high streets we are hearing some mall owners giving property waivers. So That's in a nutshell what's happening on the retail front. On the industrial front, which is basically industrial and warehousing, this is probably the sector which has been least impacted so far. A lot of people are going to be talking about diversifying their production bases, like I said. The China plus one strategy. I don't want to have everything in China. Can I have one more manufacturing destination where I could do some amount of manufacturing? So that'll benefit India. A lot of manufacturing companies today are looking at how can I have lesser reliance on China. We have clearly seen e-commerce and grocery demand go up, which is going to help the warehousing logistics sector because they need more places to store. Reshoring and near sourcing will again catch up as many companies look at domestication of production. We also believe automated vehicles, robotics, contactless deliveries, some of these things will happen. Cold storage as an asset class, which is so far ignored, will again come in. So this is probably the golden opportunity for the government to make in India. We've been talking about make in India, but we haven't seen too much of progress in that. This is that golden opportunity, and I hope the government doesn't miss this opportunity. There will be competition from countries like Vietnam or Malaysia, Cambodia, Mexico, Central Europe. But one thing we need to remember is India stands much higher in terms of availability of labor, the big domestic consumer base, multiple types of consumers, domestic economies, all that India scores much higher. All these countries which I just mentioned are 300, $400 billion economies. Short term, even the industrial sector is going through a little bit of down. But things will kind of pick up in the long run. We are also seeing in-city warehousing, so which has today you look at Amazon, they're willing to do same-day delivery. Flipkart doing same-day delivery. For that, they will not be. They will have to have in-city. They cannot rely on storage in let's say Bhiwandi and get it next day. So in-city warehousing, we are working with many e-commerce companies for in-city warehousing to kind of go up. Sources of supply, like I said, will again kind of increase. People do not want to bet on one location. See, overall, what we are seeing across all asset classes, if we need to kind of summarize, is short-term demand is down. Speculative development will definitely slow down, which means supply and new launches in across asset classes is going to get impacted, and decision making in a lot of asset classes are on pause mode, whether it's a home buyer to an office to retailer to industrial to warehousing to all those asset classes. So this is in a nutshell what's happening, and I managed to exactly catch up on 30 minutes on that. So Radhika, over to you.
So, Ramesh, that was very extensive, and I think the questions have started pouring in. What I'd encourage everyone to do is, I'll take the questions that have come in right now, but please use the Q&A button that the team is monitoring and post your questions. Ramesh, I know you have an opinion on this topic. So, many people actually are small office owners, large office owners. Your opinion on co-working as a space?
So what's going to happen on the co-working front is in the short term, there is going to be some amount of pain on co-working because co-working players are also going through a lot of liquidity issues. The good news is the industry will go through a lot of consolidation, which means a lot of smaller co-working players will end up getting merged with the bigger players. That industry will definitely go through a massive amount of consolidation. We believe it's a trend here to stay. Look at it from any corporate. Like let's say I look at JLL as a corporate. What are the 2-3 things I will want? One is I don't want to spend capex, which means a co-working becomes very important for me because a co-working is your full interiors are done up. And second is I'll want flexibility, which means if I want to get out after 1 year or if I want to get out after 6 months, I should have that flexibility. And I think both these things co-working centers operate, because of which I believe the co-working sector has a bright future. But in the short term, there are going to be challenges. Another big challenge I see is in co-working, most of the co-working centers are very densely populated, which means there's not square foot per person can even range to 50 or 60 square foot per person, which means I'm going to be sitting next to a lot of people. And today there is that scare of social distancing. Plus, you're sitting next to people you don't know. When you're walking into an office, you're sitting with people you know. But when you're in a co-working center, you're sitting with people you don't know because it's co-working, the entire community thing. You're working with different sets of people. So that again, so these are some of the pros and cons. But I think the pros outweigh cons when it comes to co-working.
Ramesh, there's a second question on an asset class that has obviously globally been very popular, but is now picking up steam, and that is the whole REIT space. I don't know if you can take specific questions on Embassy, but your comment on REIT as an investment option for investors and advisors who are thinking about REITs and how that will play out.
So REIT is definitely something which will do well going forward. Why has the Embassy REIT, which thanks to the last 2-3 months, it's kind of come down, but it did exceptionally well since its listing last year. I think the biggest thing about a REIT globally, it's a $2 trillion asset class, and it's been proven time and again, whether in US or Singapore or Europe, that there is a lot of benefits which investors can get from REITs. I think it's a perfect match of income stability, and of equity, fixed income and equity. You get both the benefits, a lot of predictability, less volatility, with regular dividends, and growing rental, and it's a highly regulated asset class also, which regulated by SEBI. So I'm reasonably sure in the next 1 year the country will at least see, once all this mess ends, maybe in the next 2-3 months. Post that, over a 12-month period, post that, I think we will at least see 2-3 more REITs coming in the country.
A question that is, I'm sure you get this question a lot, inevitable question, with the supply, at least in the larger markets, and this pertains to residential real estate. Now there's about 3 years of inventory. With the given where the rental yields are, how should a home buyer think about whether it's the right time? And I don't know if there's a timing notion in real estate to look at real estate. And what are the few factors he should think about when diligencing property? I'm sure you get this question all the time, but post-COVID, how would you think of this?
I feel post-COVID, I would say, let's say 3 to 6 months later, once things settle down, there's a vaccine or some cure which is there. I think this will probably be the best time to buy a home in the last 10 years. There would be extremely good sweet deals available in the market. Please treat residential real estate, not from a speculative or an investment point of view. You need a home to stay, and buyers will be more end users. I wouldn't recommend a residential real estate if you're looking at flipping in 2 years or 3 years time. That's definitely not the asset class. Even if you're looking at residential real estate as a investment asset class, you need a holding period of at least 5 to 10 years to see. But if you're looking at buying a home to stay, I think the next 1 year, post 6 months from today, will offer some very good deals, and that's the time you should go. And if you're very serious, please do your walking around, see all the projects available in that vicinity, and be ready to give an offer to a developer. Even if it's lower than what he's quoting, please go and give that offer to a developer. I feel this is definitely a good time, given that the stress has been around for the last 4 years. And it's something I keep saying. I know it's a little not in line with mutual fund investments, but you don't have Black Tuesdays and Black Wednesdays and Black Fridays in real estate. Even if a price has to go by 10-15% down, it'll go down in 2 years. It's not going to go down in one trading cycle or one hour. So just keep that in mind. So there is a reasonable amount of predictability. So even if you feel the prices are going to go down, and it's mainly because of one reason. Today you bought a home and you feel prices are going down on the home, you're not going to get out. One, you can't find a buyer immediately. Second, because you're staying there, your children are going to school, your wife is taking a job, your older parents are staying there, you're not going to go out. So overall, I believe you're buying a home for staying, for end use. This is, I think, post September, October, November, you'll start getting some good deals, and this is definitely a good time. See, one thing you mentioned, Radhika, was you have 3 years of unsold inventory, but it takes 3 years to do a project also, right? 1 year to get approvals, to get land zoning done, all that, and another 2 years to actually construct it, given all the high rises we all see in different cities. So it's not something which is alarming. And in most cities, if you really look at, whenever you see a research agency or a consultancy firm come out with unsold inventory data, they include under construction projects also. If you really look at uh, unsold, which is completed and unsold, that's still, I would say, in most markets, less than maybe a 15% of the overall unsold inventory. So that also needs to be kept in mind.
One question that came in, and this came in multiple times, that with work from home becoming a trend, you may no longer need to work in Mumbai or Delhi and Bangalore. And do you see demand for real estate moving from tier 1 to tier 2 cities? And your outlook on things in the tier 2 space.
So I think it's a very good question. We work with the big corporates. Last year we did close to 750 office transactions in the country. So we work a lot with corporates. In the last few weeks, I'm beginning to hear that corporates asking us that, why do we need all these large centers? Can I have a small presence in a tier 2 city, maybe let's say a Cochin or a Vishakhapatnam or a Nagpur, where I can get talent, and maybe I'll take a small office there, and maybe people can come once a month and just check in and do whatever HR formalities, finance formalities, and go back and work from home. So which is, again, from a liquid workforce point of view, this is something which is like today we are, as a firm, looking at having a liquid workforce strategy. How do we get women who went to deliver children to get back to workforce? How do we get people who went to take care of elder parents to come back and work? How do we get retired people to come back and work? How do we get ex-servicemen? How do we get government servants, IAS officers to come and work? So these are some things which we are debating, and the tier 2 strategy falls in place, but very early days, Radhika. Maybe in 3-4 months, we'll be able to get some better view on that. I have my own apprehensions about work from home. Humans are social beings, and it's not easy to work from home. How do you create a company culture? How do you give company values? All that with people sitting and working from home. There are also many legal challenges which are slowly emerging in terms of confidentiality, and the number of risks involved with regards to malware, ransomware. All that is beginning to go up, and the last thing you'll want from India in India out. Today we don't have a choice. We are forced to work from home. If you ask any CEO, he'll say, "Oh, we are super productive because analysts need to be kept happy." Even if you ask me, I'll say we are all productive. But I know we are not all productive because obviously OTT consumption has gone up significantly, which means people are watching Netflix and Amazon much more. It's not just travel time. I'm sure there is some office time also where people end up productivity. Whatever people say, there is an office environment is very different from collaboration, from innovation point of view, creative point of view. There are like 100 different positives of working from an office. And we saw this. We did this. We've been talking to a lot of clients. April was reasonably productive from a work from home point of view. Many companies, many of our clients said that May, because of the fatigue, the overall productivity levels started dropping in May. June, I don't know, but I will check. But nobody can write off office space and say that everybody is going to work from home.
Ramesh, there's a philosophical question that's in analogy to the equity markets. I like the question. So in equities, we say that there's a 6, 7, 8 year cycle in equities. What kind of cycle is there? I mean, you've been in this business for so long. Is there a 20-year cycle in real estate? Is that true? And where are we in the cycle?
So one of the things I used to really impress when I used to go for a meeting was how cycles used to behave in real estate. But the last 3-4 years, all that has gone for a toss, Radhika. It's so tough to predict real estate cycles. One has to look at it from an asset class by asset class point of view and a specific city by location by location point of view. You cannot kind of generalize cycles. I still remember the cycle from 1993 to 2003. That was one cycle. So you saw 93 to 96 things go up. 96, 97 it peaked. From 97 to 2002 it kind of went down, and from 2002 again it started going up till 2008. 2008 9 it peaked, then 2009 to 12 13 it went down, and again in 14 15. So cycles were kind of reasonably predictable. What we are seeing is those 8-year 10-year cycles becoming much shorter. Going forward, I think cycles would be like 3 or 4 years, and one needs to be ready for getting in and out there, and predictability also. And it's reasonably okay to predict, given that real estate, there's a lag time. Today if I decide to do a project, by the time the project is ready, it's going to take 3-4 years. So there's reasonable amount of predictability you can have. But given all the residential, the last 4-5 years has been tough across the country. So someone in the residential, tracking a residential cycle, would have said things would have improved 2 years back, but it hasn't improved, right? So there are multiple factors at play. Your demonetization, your RERA, your GST, then you had ILNFS, and now you have COVID. So every year there's something or the other which is happening, which is kind of impacting that predictability of cycles. So, but I was a super predictor of cycles till 2-3 years back. Now it's kind of everything has gone for a toss.
Someone's asked you, Ramesh, a very controversial question. I think you'll answer it well. So Piyush Goyal has apparently bluntly told developers to cut rates and not expect any help from the government. How is the developer community viewing sort of the government's role in this? And do you think they're going to keep prices where they are, or do you think they're going to be under pressure to cut prices?
I think Mr. Parekh and Piyush Goyal both had talked about reduction in prices. What they actually meant was that if you're sitting on unsold inventory and it's ready, please cut prices and sell. That's what they meant. But I think when developers heard it, it looked like across the board you should go and cut prices. So developers were upset with both their comments, but that's exactly not what they meant. I attended both those webinars where they spoke. They said, and at the end of the day, developers are smart business people, or they wouldn't have made so much of money. They've also, developer community has also come back and said circle rates, what we call ready reckoner rates in Bombay, have also been kind of going up. So even if you sell it at a lower price, you have those income tax issues. You need to still pay stamp duty based on the ready reckoner rate. So all those challenges, the developers have made good amount of representation, and I'm sure the government will look at it. So even if a property is at 10,000 rupees, and the developer gives it to you at 8,000 rupees, you still need to pay stamp duty at 10,000 rupees, because the ready reckoner rate has been constantly going up. Why is it going up? The state governments need money for infrastructure and all that. So they haven't kind of cut ready reckoner rates, point one. Point two, given if you're paying lower, the typical income tax authority thinks you're saving or you're doing a cash deal, thereby not paying 10,000 rupees and you paying 8,000 rupees, and you still have to pay income tax on that. So these are some of the challenges which the government needs to kind of fix, but that is definitely not the intent of Mr. Parekh and Piyush Goyal when they made those statements. Their statements was don't increase your losses. If you have ready products and if you don't have the withholding capacity, please go ahead and sell. That's what they meant.
So there are two interesting questions. One is that, and this is a competitor to mutual funds, but I'll still ask it, is that what is the profile of returns you should expect in REITs? And is REIT supposed to be an FD or debt product alternative? Is it supposed to be stable income? How do you think about REIT investing?
I would say REIT investments, given some of the benefits I spoke about, less volatility compared to the rest of the equity markets, more predictability compared to the rest of the equity markets, more tangibility compared to rest of the equity market, because at the end of the day, REITs own office buildings which you can touch and feel. It's not paper money. It's tough to put a given the current valuations. I think it is safe to expect at least a 8 to 10% return. Because last year when Embassy was getting originally listed, the expectations were 14 to 15% at that time, which actually was even more given whatever it went. And over the last 2 months, it's kind of come down. If you look at one, rental income, you add yield compression to that, which will easily be another 3-4%. Mark to market, which your tenants were paying lesser, kind of paying you more when it comes for renewal, because the market has become more. If there's a 50 rupee tenant and the market is 80 rupees, then the tenants look. So all those extras which was there were coming to around the 14-15% mark. But even in this environment, I feel it's a safe thing to expect 8 to 10%. So there are various people at various stages of K. Corp would come out with a REIT soon. You have Brookfield, which may come out with a REIT. Punchfield may come out with a REIT. There may be some other office developers who would think of a REIT. So I think all these could be hitting the market in the next 1 to 2 years. But I'm not sure how many, what's the room for so many REITs. But definitely there would be room for 4-5 REITs. And like I said, globally, it's a $2 trillion asset class. And in our country, we have only one. So there would be all kinds of REITs coming, retail REITs, industrial REITs. In US, you even have so many private prison REITs, which are there. So it's a much more evolved capital from a REIT market point of view. So I think it's a matter of time before. I'm reasonably bullish on REITs, because unless some economy goes through some Japan kind of 20-year recession and all that, I'm not too worried about investing in REITs.
Ramesh, one question, and maybe once the REIT market is a lot more developed, we'll do another session with you on REIT specifically. But it's been some time since RERA has, stepping away from some of the COVID issues, it's been some time since RERA has come to the market. How have you seen the impact of RERA play out on real estate? And within the real estate pack, how have you seen different builders adapt in the post-RERA era?
Overall, the biggest problem pre-RERA was developers were always delaying their projects. And there's one research we did, this is pre-RERA, where the average delay in Bangalore was around 9 months. The average delay in NCR was 5 years. So you bought a project, you waited for everything, and then they will take another 5 years to finish the project. So it is very messy. And that's the reason, I think, fantastic achievement by the government. So two big achievements by bringing in RERA. One is that 70% escrow rule, which means your 70% of the money can only be used for that project. That was not happening before. Developers would take stuff and go and put it in somewhere else, buy land, do something else and get into trouble. And then this project would never get completed. So that's a big thing the government has done. Second is defaulting developers today are very scared because of the imprisonment clause in RERA. And these two are true game changers. The problem is the government had left execution of RERA to state governments. And many state governments have actually diluted it. Some state governments like Maharashtra have done a good job. But otherwise, a lot of state governments have diluted it. So I think that's where the crux is. It depends on which state you are in. But at least that fear of going to jail and the fear of not making sure that 70% is kept for that specific project. I think these are big achievements. And I think it's one of the good things the BJP government has done in the first term was bringing in RERA, which is overall a good thing. But today what is happening is a lot of developers are a project which can get completed in 3 years, they're putting 6 years just to safeguard themselves for that balance 3 years. That's where I think the rules should get stricter. The buyers should also, but it's making the market a lot more transparent. I still remember around 6 years back in the JLL Global Transparency Index, India's ranking was to be around 55. This is real estate transparency. Now it's at around 35 or 36. So, which means we are improving on the transparency rankings across. I still remember when I joined this firm 21 years back, India's ranking was as good as our football global ranking. We are not even there in the top 100 at that time. And we are now in top. Things can be better, but things have still improved. So home buyers today need to be worrying less than ever before because of RERA. Second, your sizes are also a lot more attractive today to you. And today, a lot of apartments are nearing completion or completed, which makes all the more reason that you can go buy. So I think overall, it's a good time for residential buyers to go and buy apartments.
Ramesh, one question, and I know you and I have spoken about this. Given JLL's footprint in so many markets, and given that fact that some of these markets are actually recovering from COVID before India, I mean, China's got back on its feet before India, the US is mixed. What are your learnings from some of the other developed markets about some of the trends in real estate? Specifically China, because I know we've spoken about that.
Great question, Radhika. In China, surprisingly, office occupancy rates. I was talking to my China country head a couple of weeks back, my counterpart there, and he was telling me office occupancy rates are like 90%. In India, we're struggling to get 10% back to work. China has touched 90%, and a month back it was around 75-80%. So seems like China is just back to normal. That's one trend. Residential, which had let's say pre-COVID was 100, sales were happening, and during COVID it became zero because no one was buying anything. That's again up to a 55% mark, which is again quite good. And I sit on these calls with my country heads of Hong Kong, Singapore, Australia, and something which is quite embarrassing at that time is all these guys get wage subsidies. So we in Asia Pac have 45,000 employees who work in different parts of Asia Pac. And governments give wage subsidies for companies like JLL saving jobs. I wish I had those kind of benefits when I present my P&L for the month or for the quarter. So I don't have those benefits. But these countries are also doing phenomenal things to get their economies kick-started. Office activity levels, office real estate, residential, I said, had come to a 55% mark. My colleagues in China, when I checked with them, they asked them the same question you asked me now, Radhika. Office activity is around the 65% mark again. So things are kind of looking up, which is also some silver lining for us, because if you look at that, hopefully India will also kind of bounce back. But right now, you check with any guru of India, they'll all be very negative with regards to our revival curve.
So I'll ask you two more questions. One was a question that came in after you mentioned what you did, that since JLL and companies in real estate are such large employers, what is the one thing the sector is looking from the central and state governments as a real estate industry?
I think we all know that the construction and real estate sector is the second biggest employer post agriculture. So the government definitely needs to think of reviving this sector. And it's all got to do with domestic consumption. I know I mentioned about home loan rates being a 15-year low. I think those kind of things should be done more so that consumers feel like buying more real estate, better tax breaks, lower interest rates. But the need of the hour for the industry is a one-time restructuring like they did in 2008-9. There was a lot of hope of one-time restructuring till Piyush Goyal's speech that evening. After that, the shoulders have been a little drooping after that. But till then, there was a lot of expectation because all the developer bodies like CREDA and NAREDCO and all that had made lots of representations with the finance ministry, and a lot of question answers were happening, and they were all very confident this will happen. I think if there's one thing the government can do is one-time restructuring of loans. If there are two things the government can do is second would be reduction of GST, and third is if there's one more thing the state governments can do is bring down stamp duty and related costs, which is in the purview of the state governments, and also bring in ready reckoneries. The government can also do that other thing which I said, which is not penalizing the home buyer who's getting a lower cost. So those couple of income tax acts also needs to be simplified.
So the last question, Ramesh, and multiple people asked it, if you had sort of an infinite amount of money or whatever that is, and you had to make investments in real estate over the next 6 to 12 months, what parts of real estate would you make investments in, and what cities or spaces? How would you divide your real estate?
I would say the top 6, 7 cities all are good: Bangalore, Chennai, Hyderabad, Pune, Mumbai, Delhi, and Calcutta. I think all cities has its benefits. If it's a one asset class I need to pick, I would pick office. But I would pick an office only if you don't own a home. If you own a home, which you already stay in, then I would pick up office. But if you're still staying in a rented apartment, and you've been or staying in a home and you've been wanting to buy a bigger home for the last 4 5 years, I would say go for buying a home. Office, mainly because today a lot of developers across the country are doing small office units. You can get office units from 2 crores to 10 crores. So that's definitely something one can look at. And office yields are also not bad. You can get 7 8% there, compared to residential yields of 2 2.5%. So I would, given all the uncertainty around retail and hotels, I would kind of stay away from those sectors at least for the next 6 9 months, because today you can't value retail, you can't value hotels, because it's so much of uncertainty and so much fluid. So that'll be my advice. But look for sectors where office demand is good. That's where Bangalore scores. Pune and Hyderabad scores. These are the three biggest cities in terms of office demand, which means a lot of job creation is happening. And when job creation happens, obviously, a lot of people will want to buy residences. Capital appreciation will happen. When you buy something, it's easier to rent it out, even from an office point of view. So the three most vibrant markets are Bangalore, Hyderabad, and Pune.
Ramesh, thank you so much on behalf of all of us. We actually had fantastic turnout today. So thank you for giving us such a comprehensive overview of the real estate segment. And I really hope when we have a lot more REITs, we'll come and bother you about that. So thank you everyone for attending and for your range of questions. I'm sorry I couldn't take all of them, but there were really quite a bit of them. So thank you so much, and look forward to another edition of Connect. Again, Ramesh from Edelweiss and Edelweiss Mutual Fund, thank you so much for joining us.
Thanks, Radhika, for inviting me. Great set of questions. Thank you.
Thank you. Thanks, everyone. Good evening.